All right, so they've been all over the place right this week. Members of the Federal Reserve making really big news. It's got the bond market and the stock market both moving, I think, maybe in opposite directions. We are lucky enough, though, to cap all of it off with a very special guest. And I want to get to Edward Lawrence, who begins our exclusive interview with Federal Reserve President, Bank President of San Francisco, Mary Daly. Edward, take it away.
Yeah, thanks, Charles. And she is a voting member this year in San Diego. I'm in Washington, D.C., where there's 5 inches of snow. I should rethink my travel options here. But thanks for doing this, Mary. I appreciate it.
Yeah, thank you for having me. Glad to do it.
Yeah, so let's get right into it. The markets are saying that rate cuts will come as early as March. We're still seeing a strong jobs report. The core inflation is not coming down to the 2% range. It's 3.9% for the latest CPI report. Can you really forecast rate cuts? And what meeting do you see those rate cuts starting at?
So the first thing I want to say is we don't have inflation back down to 2%. Everyone knows that. That's not price stability. We are fully committed to restoring price stability and doing it, of course, as gently as we can. But we have a lot of work left to do. We are not there yet, and it's far too early to declare victory. So while I think it's appropriate for us to look forward and ask when would policy adjustments be necessary, so we don't put a stranglehold on the economy, it's really premature to think that that's around the corner.
And we say around the corner, meaning maybe not even July, could be longer throughout 2024?
Well, I'm not going to put I think giving certainty or giving even a sense that we have certainty when all we really have is questions is actually not optimal policy. It could be a policy mistake. So what I'd like to do is, in fact, explain what are the conditions under which we would have to make adjustments. So that's where my head is now, and I think that's appropriate. Okay, let me talk about my benchmarks. I think that's the best way to think through it, right? Right now, inflation still came in at 3.9%. We need to get that on a consistent trajectory heading back down to 2. We need to see more evidence that it is heading back down to 2 consistently and sustainably for me to feel confident enough to start adjusting the policy rate. Right now, we also have a labor market that is slowing. There are signs of slowing, but it's not faltering in any way. So I'm going to be looking for 2 things. Do I get consistent evidence that inflation's coming down, or do I get any early signs that the labor market's starting to falter? Neither one of those right now is pushing me to think that an adjustment is necessary, but we definitely want to keep our eyes on those things. Ultimately, our job is simple, and we've committed to do it. Bring inflation down to 2%, restore price stability as gently as we can.
Yeah, so if inflation remains higher and there is a rate cut, then how do you do that and hold the appearance of independence from the Federal Reserve?
So Congress gave us 2 very important jobs: price stability, full employment. We've talked about those. To do those jobs, we have to look at the economy and make the adjustments we think are necessary to ensure that we can achieve both of those goals and balance them. And so that's all my focus is. Americans deserve us to get this right, and we're going to do everything we can to make that so.
Yeah, and now I want to bring in Charles here. I know he's itching to get a question in here. Charles, what do you think? What do you have for Mary Daly?
It's amazing because the street, Wall Street, and the Federal Reserve have been on opposite sides of this equation for a while. But when Jay Powell at least acknowledged that there were going to be 3 rate cuts instead of 2, everyone took it, okay, at least the Fed is going to be accommodative. They're going to be on our side. And we'll see what happens, how that plays out. Interesting enough, even with today's data and the signs that maybe yields are going back up, Wall Street, this rally continues. I want to ask you about the banks, though, because a headline that caught my attention: U.S. prepares rule forcing banks to tap Fed discount window. Now, for folks who aren't really familiar with it, there was a report from the Federal Reserve in December 19, 2017 titled "Stigma and the Discount Window." We know banks do not like to go to the discount window for a number of reasons. So the question is, why would the Federal Reserve force banks to go there? And I'll tell you the conspiracy theory, and you can tell me if we're wrong. The idea is that there's a lot of banks out there with a lot of problems. And if they go to the discount window, we're going to know who they are. Their stocks may falter, and it may trigger some sort of a panic. Is there any other reason why you would force a bank that doesn't need to go to the discount window to go there?
So let me first say that I don't make regulatory policy. That's the job of the Vice Chair of Supervision, Michael Barr, the Board of Governors, the FDIC, and the OCC. So I don't really want to comment at all on the policy rulemaking that's being discussed there because it's not my responsibility, and it's premature for me to even comment. What I will say, though, is that the discount rate window is regularly used by banks. It's an important aspect of funding for banks, overnight funding. Many banks in the nation use it. And the stigma paper was really about recognizing the importance of the discount window, that the important role it plays in providing liquidity overnight.
We did have, though, an emergency funding facility that runs out in 36 business days, and there's some anxiety about that running out, even as it's being tapped. Yes, last week was the second largest amount of money tapped from this facility, and people are wondering if there's some sort of bridge being created just in case. I want to ask you about the role of shadow banking. It is just growing enormously. You know, the private credit side of our economy, how much control does the Fed have over that?
So, as you know, we're regulating and supervising, and really the Board of Governors, the banks that are within our system. And there are many aspects of the financial system that are outside of that ring fence. One of the roles that regional Fed presidents play in assistance with the regulators is we're out in the field, if you will, constantly talking to financial intermediaries of all types, private equity firms, et cetera, and sourcing information about what they're doing, where they're investing, how they're feeling about the economy and what they're seeing. And so we have a handle on that information that we can then bring back and really ensure that we're making not only good monetary policy decisions, but we're also understanding the risks to financial stability.
Yeah, it just feels like for a lot of folks, the hedge funds are become so powerful and more opaque at the same time. I want to ask you one thing that's a little personal, but I was reading your bio, and there was something intriguing in there. It mentions your belief in 3D public service, that the need for public servants to be fully human, vulnerable, compassionate, optimistic, pragmatic. And I wanted to know, how does that influence your decision making on monetary policy?
I rarely get asked a question like that, but I'm totally happy to answer that. So ultimately, right now is a really good example. We have high inflation that still needs to be brought down, and we have a labor market, a full employment mandate we also need to watch. And so that idea of being empathic and thoughtful and talking to the people in my district and understand what they need really helps me understand that if we go too fast to adjust policy, we leave inflation too high, or we go too fast to adjust policy or to raise interest rates more, and we break the economy and people lose their jobs, then I've actually helped no one. And so I always have, you know, the economy is about people, and I keep those people in my mind. I'm always thinking about that one American, but that's many millions of Americans who actually want two things. They want price stability and full employment, and that's what drives my job.
We got less than a minute to go. By the way, thank you very much for that answer. Edward has one more question for you.
Yeah, I've been itching to ask you this, Mary. So we saw strong retail sales for December, and there's record credit card debt. When does the consumer reach a breaking point? You got about 30 seconds.
Okay, the American consumer is actually incredibly resilient. They continue to spend. Did you see the survey results on sentiment and optimism and confidence? They're really high. So right now, American households are in good positions in their balance sheet, but it is very important to watch what's happening with delinquency rates and other things. Those are early warning signs that the economy is slowing and there's a rebalancing. And it's one of the inputs I'll take into policy decisions.
All right, Fed President Mary Daly, thank you so much. Edward, thank you as well. And folks, just so that you know, there's $1 trillion in credit card debt. There's still another, $1 trillion. There's still $3 trillion out there. I pray we don't tap it. We'll see.